A major shift in market attitude has been caused by several billion fund managers. Contrary to the general consensus, many people have recently started to become positive on the market. Welcome to our channel, Financial Experts. The likes of Warren Buffett, Charlie Munger, Bill Ackman, Jim Simmons, Cathie Wood, and Chamath Palihapitiya have made significant investments in high-growth sectors including technology, innovation, e-commerce, and many more during the past 2 quarters. On the other hand, some fund managers are still being cautious at this moment. Managers like Michael Burrier are standing their ground because they believe a severe market meltdown is imminent. This raises the question of whether the global markets will trend upward. In this video, we'll examine more closely the divergent fund managers' perspectives on the stock market and how those perspectives could affect the present situation. Chamath Palihapitiya recently predicted that there might be another decline in the S&P 500 index on an episode of the All In podcast. Chamath predicted that the S&P 500 would bottom out at 3,800 and that large cap business would suffer. Since the S&P is now at about 4,200 points, it appears that the final plunge won't be too far off. According to the present market attitude, sellers are value investments and purchasers are growth stocks. Billionaire businessman and renowned venture capitalist David Sacks, according to a study cited by Sacks, the values of internet and SaaS firms have decreased dramatically. EVs afford revenue multiples have increased throughout the 2-year COVID-19 timeframe and have decreased starting in November 2021 to historical norms. Although there is a chance that this may continue to fall, historical data suggests that time to start looking for deals is now. In the last 12 or so years, Brad Gerstner has released a few charts essentially illustrating multiples in the internet box as well as SaaS business. And as you can see, there has been a significant increase in multiples for internet firms and SaaS companies throughout the past 2 years of COVID. And it has now decreased over the past 3 to 4 months, actually since November. And as of, well, last week, I would say it was about in line with the historical tendency, as well as is now beginning to deviate from the historical trend. So from the perspective of someone looking for a deal, you could say that this represents the first time the market has been under average in the past few years. Now, this is not to suggest that it cannot decrease further because it is possible to be both above and below the trend. But this may be bargain shopping if the war can remain contained and there isn't a recession as a result of all that has transpired. Cathie Wood, the CEO and CIO of ARK Invest, who had a 170% return in 2020, ably supports this viewpoint. The underlying circumstances of cheap interest rates and significant stimulus were partially to blame for this. ARK's flagship innovation ETF has, however, recently come under criticism. The ETF is down 22% year-to-date and 55% off its 52-week high. Investors in ARK are currently dealing with a climate of increased interest rates that are likely to be considerably less tolerant of not-performing firms trading at greater valuations. Cathie's top 40 stock holdings have decreased on average by 41% during the last 3 months. Comparatively, the decline in the shares of ARK's rivals has only been about 14%. The higher decline is a result of ARK Investment's preference for firms with strong growth rates and rapid disruption. She asserts that these losses are transient and that on January 27, 2022, the bottom fell out. According to Cathie, the equities contained in the ETF will return to their previous levels and then continue to rise. ARK's investments, which are currently tilted toward a few high-growth businesses, indicate her strong belief in the market's ability to recover. ARK's continued investment in innovative businesses is a reflection of its investing philosophical thought, which focuses on businesses with the greatest ability to innovate. To prove their positive attitudes, other fund managers additionally made investments in businesses with strong growth prospects. Recently, Charlie Munger strengthened his stance and defended his ownership of Alibaba. According to him, the firm is a major player in Eastern cloud computing and e-commerce. Bill Ackman bought Netflix early this year despite his normal trepidation about technological equities due to their increased valuations. AMC and GameStop were two of the greatest well-known meme stocks to gamble on in the fourth quarter, according to Jim Simons, the chairman of Renaissance Technologies, one of the best-performing hedge funds ever. Several billionaire fund managers possess a commonality running across all of their investments. Knowledge of the conduct of these managers of funds also requires the knowledge of their timing. These investments were all made in the fourth quarter of 2021 or the first quarter of 2022, proving that the fund managers are seeing a lot of profitable chances in the present market outlook. Unprecedented sanctions imposed by several nations, notably the US, have increased uncertainty and caused the stock market to experience high volatility. The US administration has prioritized imposing financial penalties against Russia in particular. By imposing restrictions, the West and Russia are now engaged in an economic conflict. They have only ever used them against hostile foreign governments like Syria, Iran, and North Korea. To stop Russia from obtaining the majority of the sizable foreign exchange reserves, as well as depreciating their currency, is the main justification for this. As a result, Russia no longer has access to international debt markets. This further weakens a market that continues to recover from the effects of COVID-19. Because they will have an impact on the Russian energy sector, the sanctions are expected to have a significant inflationary effect. A significant amount of the oil supply has proved affected since Russia ranks third in the entire globe in terms of oil production, after the United States and Saudi Arabia. The price for oil, which has risen by almost $20 per barrel in the previous month, has already factored in this unpredictability. The worst result may be stagflation, which is a combination of high prices and slow economic development. Being in that scenario would be tragic, since any attempt to reduce inflation would just lead the economy to tumble even more. Additionally, the supply chain becomes even harder as a result of these sanctions, leading to an increase in food prices, a rise in airfare, and additional travel restrictions. The longevity of high inflation has astonished federal policymakers, who had assumed that the pandemic's rapid price rises would only be temporary. Evidently, such wasn't the case. The Fed's policy priority is still controlling excessive inflation, though. Michael Burry is one of the oddballs in this mixture. Prior to learning anything about this situation in Ukraine, Burry sold off the majority of his US equities late last year. By doing this, Burry was able to avoid stocks like Golden Ocean, Marinas Pharmaceuticals, and Scorpio Tankers that were taken from tanks after the disaster. These three equities have fallen 25%, 44%, and 43% respectively since quarter 3 of 2021. Burry, however, failed to profit from several of his assets that saw an increase in value, including precision drilling, Occidental Petroleum, and the Ingalls markets. These three equities have increased by 91%, 38%, and 26% correspondingly from quarter 2 of 2021. Burry is only one of several billionaire fund managers who are getting more and more confident about the market. However, there are certain possible worries that the market is now dealing with, and that will likely remain in the foreseeable future. Despite the market's present volatility, billionaire fund managers are prepared to ride out the next storm. In fact, a lot of them think that now is the moment to buy stocks on the cheap and select those that will actually succeed. Okay guys, after a long discussion, this is the end of this video. Let's meet again. Thanks for being to the end of the video. Don't forget to like, share, subscribe, and tell us what you think about this video below in the comment section.